US stocks rose for 9 days straight through the end of the week ending May the 2nd, marking its longest winning stretch since 2004. To discuss the latest on economic data and markets, I'm joined by Chief Market Strategist Steve Sosnick. Morning, Steve.
Good morning, Andrew.
And Senior Economist Jose Torres. Good morning, Jose.
Good morning, Andrew, Steve.
All right, so Steve, let's start with you. The longest winning stretch in 21 years for the stock market. Can it last?
Can it last? Sure. Should it last? That's probably a little bit trickier, but you can't it's almost impossible to just count this market out. The love that investors have for buying dips and chasing rallies is quite pronounced, and it was very much in evidence. Momentum as a factor is great when it's going in your favor. It stinks when it's not, and it was going in people's favor for the last few days. That was a big plus. And as a result, off we went. Can momentum continue? Sure. Do we have the potential to have a big momentum changer this week in the name of Jerome Powell? Absolutely. So we'll see what happens.
Okay, Jose, last week was massive for economic data, culminating in a still strong display from the employment report. What struck you most about the economic releases last week?
I thought the negative GDP print was quite significant because you got that 0.3% contraction, but under the hood, the numbers are actually pretty strong, namely consumer spending and business investment. Business investment was the strongest it's been since the pandemic recovery in the fourth quarter of 2021. We had 3 weaker than expected employment reports last week: Tuesday JOLTS, Wednesday ADP, Thursday unemployment claims. But then Friday payrolls, we did get that big beat. Just a reminder, as we all know, there has been a tendency for payroll revisions to come in on the downside. So that numbers get revised south, came in at 177. Expectations were around 135. We got some pretty good job growth across sectors. The ones that lost jobs barely lost any. That was retail, manufacturing, other services, and utilities. As far as some of the headwinds that may have impeded this kind of number, immigration restriction and government spending reductions, we actually didn't see that. We saw that the reduction in federal government employees was totally offset, and then some, by hiring in local and state governments. And then as far as immigration restriction offering somewhat of a dampener on labor market growth, we've seen the labor force participation rate and the labor force expand pretty significantly into this year. So pretty good, not excellent economic reports, but pretty good economic data last week.
Steve, big picture, are investors getting accustomed to the new White House?
Yeah, to some extent, I think individual investors are, because again, the focus is not on the big picture so much as are things going up today, tomorrow, or the day after. I had a friend of mine who was a retired bond portfolio manager describe it as, and this guy was, and let me preface it by saying I know he was a Trump voter, that we basically elected an arsonist, and then we reward him every time he brings out the fire extinguisher. That's not going to, the problem is one of these times the Santa Ana winds kick up and the blaze gets out of control. But for now, I think the markets have just come to deal with the idea that chaos is the norm. And at least I'm not sure that global investors agree that's a good thing, but I think domestic investors have come to terms with it, at least in the short term, for now.
Steve, I'll come back to you on the bond market in a minute. I wanted to ask Jose, we've got an FOMC meeting coming up this week for May. Any optimism there for an interest rate cut?
No, our market only offers 6% odds of a cut. I don't think you get a reduction this week. There's been pressure from the White House to lower borrowing costs. June, however, the path there is a lot wider. Our prediction market is at 39% for a cut at the June 18th meeting, which is in roughly 6 weeks. I think to get a cut this week, you would have needed a payroll report, which was much worse. But I do think that in June, we do get a reduction. Inflation has been cooperating. Energy costs today, crude oil is trading at an over 4-year low when you exclude its recent low made a few weeks ago. So you're at declining energy costs are going to offset some of the inflationary pressures from goods if we get them that are tariff induced. So inflation 2.3% headline PCE. I do think you can sneak in a cut or two before you get a potential uptick in goods inflation.
Steve,
May I,
what are your
may I
thoughts?
just, yeah, may I? Because I just want to point out that Jose is very much at this point outside the consensus, and there's nothing wrong with that, by the way. Right now, the prediction markets for whether it's Forecast X or the CME FedWatch, they're both in the 30% range. That's come down significantly after the good economic news that Jose discussed earlier, and they're basically around the first full cut is priced in for July, but it was almost a dead certainty for July. Whereas now it's not 100% certain. It's a little bit less. And so I think the problem I have here with the difference I have, it's not a problem. The difference I have is that number one, I think Chairman Powell does not want to look like he's getting pushed around. And considering that the 90-day forbearance ends on July 2nd, I believe. The June Fed meeting is before that. So I think he's well within his rights to say, I'm going to wait and see even one more time. And I don't really care that. And I think he's so concerned about the Fed's independence that he's basically going to, each time I think the president yells at him, I think his natural impulse is to basically say, no, not unless I need to. And if I need to, that's careful what you wish for type of thing. And so I think he's going to have the cover until July to basically say, I'm not going to do anything until I know how this tariff stuff transpires. That's a difference of opinion. I think that had bad economic numbers pushed him in the other direction, he's not going to play games. But I think that's the issue that I think we're facing. Again, I think the market expectations have come down considerably. They were more for looking around four cuts for the year. Now we're looking around 3 for the year. And I think we'll find out also more what the bond market is thinking because you have a big auction week this week. We're taping this Monday morning before the 3-year auction. We then have a 10-year auction tomorrow. They take Wednesday off for the Fed meeting and then auction 30 years on Thursday. So it will be a very big tell. And I'm told indirect bids are the way to look at this. As to whether there will be a lot of foreign participation in the auction. The Japanese had threatened to stay out of the auction. Then they withdrew that threat over the weekend. China, I don't know if they're willing to play that kind of hardball yet. But in general, I just still get the sense that it's Americans buying and foreigners selling.
Jose, any additional thoughts on the bond market?
I want to talk a little bit about Steve's topic earlier. Inflation in April, my nowcasting models show the CPI at 2.3%, PCE at 2.2%. When I see the Fed's target rate at 4.37, that's positive real rates in excess of 200 basis points on a comparison. You combine that with really energy costs that are plunging and the potential for tariff inflation, right? Just the potential, because we might not actually get much price pressure upticks from the tariffs. Remember in Trump 1.0, we got a little bit of price pressures. Of course, the focus was more on China, not everyone else. But I'm optimistic that we can get some trade deals done with some of our allies, South Korea, Japan, India, EU, and then we can focus on China again on the trade front, not necessarily on everyone else. And I think that can get us a cut or two. But your points are well taken, Steve.
Yeah, and again, I guess where we come in here, Jose, is they've been fairly cagey about trying to tell us where the neutral rate is. I think the implication is, and certainly I think the implication from the Fed and certainly from your comments just now is that it's somewhere below where we are now, but I think they've been reluctant to say what it was. And I think one of the things that's got to get asked at the press conference, and we'll see if Powell chooses to answer it, is if the two parts of the dual mandate conflict, which do you err on the side of? Meaning that if labor starts to fall off, and it hasn't yet, you made some very good points about Friday's numbers that show that if there's labor troubles, they're not necessarily here yet. But if labor starts to falter and or prices start to go up, which do they go for first? Is it the fear of restoking inflation? Or is it and that's where I come down on the idea, your points being very good. That's where I come down on the idea that Powell is more wait and see, because I think he does not want to go down as the guy who cut rates just before tariffs went up. And I think that's why he'll want some certainty in that regard, which could come. And that's why, I think we're all rooting for the idea that we get trade deals and get the tariffs down and out of the way. But I think barring that, it's hard to see him being the guy who cuts rates, but going before that occurs without that policy certainty. But then as we go forward, if it does appear that we're in a, and I hate to use the word stagflation because this is not 70s stagflation, but if you're in a situation where there are price pressures and there are labor market pressures in the opposite direction, what's the Fed's move? Which do they favor? Do you have a sense of that, Jose, or not really?
Yeah, we covered this 2 months ago.
Yeah,
I think
I know.
70-30 on the labor side.
Okay. I
think
I seem to think he's more price pressure-ish, and we'll see.
That's
This is
interesting.
what markets are made of.
The New York Fed governor last week, Steve, said he'd be all over any deterioration in the labor market.
Yeah, but then there's some other comments about concerns about price pressures from other Fed governors. So I think even there, I don't think they know, and I think that's really what we're all going to have to figure out. And I think that's going to be an important thing to listen for in Powell's press conference on Wednesday.
Very good. Steve Sosnick, thank you for joining me. Jose Torres down in West Palm Beach. Thanks for joining me.
Take care.
Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Hong Kong Limited, and Interactive Brokers Singapore Pte. Ltd. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX.